It's a pleasure to be here for another year. It's been a great experience. I think SAHIC is a unique event in our calendar, and it's a pleasure to be here representing Lighthouse. Lighthouse is a technology company provider for hospitality business with a little bit more than 75,000 hotels worldwide. The idea of this session today is throughout the next 20 minutes, we're going to discuss a little bit pricing and demand for our region. Yesterday, Patricia was here. She was showing ADR and occupancy, and I'm kind of going to resonate her numbers a little bit because I'm going to talk about public pricing. So what public pricing is pricing that are on Booking.com and other channels. And also I'm going to speak up a little bit about demand. So a little bit of an overlook on how was last year, but also for future, for the rest of this year, how are we trending in specific markets. So we're going to cover all those three points, and at the end, I'm not going to get really deep into short-term rental. I'm just going to share a few numbers just to be cautious with time. So first of all, pricing evolution. Again, when I'm talking about pricing here, I'm talking about public pricing and not ADR. These are two different metrics, but it's good for us to have a view on what are the trends for public pricing. This is a graph that shows for H1 2024 versus 2023 and H2 2024 versus H2 2023. What was the growth in terms of public pricing variation for different regions in the world? And we see that the Latin America region had the highest growth in terms of public pricing, right? So that's a very important news and a very important trend for us because that trend has happened also in 2023. So what that means is, in terms of public pricing increase, we're being outliers worldwide, right? It's a very different scenario where versus you see in other countries and other regions. One of the reasons is the inflation pressure. It pressures operators to keep increasing their rates, but also gives the customers the perception that prices go up and we have to deal with if we're going to travel for corporate or leisure purposes. So the good thing is in both halves for last year, the growth was really steady, 2 digits, and that we heard yesterday, I think Thomas was saying a 10% increase in our RevPAR last year. A lot of those results for the global chain hotels, but also for regional groups in our region was carried by that huge increase in public pricing that affects directly the ADR. When we split that a little bit between independent hotels and branded, we see the branded hotels carry a lot of that increase and a lot of that effort, right? So very big importance the branded hotels have to the market because they elevate the bar of the market, right? They pull the level up, and the independents, they try to follow that. So almost 27% increase on average. That's only H2 last year versus 2023. A big impact. And again, an outlier versus when we see in the other regions worldwide. And then also good news is the 3-star hotels, 3 and 4-star hotels, right? We've seen post-pandemic a big increase in 5-star luxury properties in terms of pricing and ADR. Now we're also starting to see a big trend in terms of increasing ADR and increasing, in this case, public prices for 3 stars and 4 stars, right? In the economics, brands is a little bit more constrained, so it's 7% increase, but still good news, and especially on the 3, 4-star hotels. I think we finally saw a very consistent H2 comparing versus 2023 in terms of a very steady growth for those hotel categories. A little bit in terms of spotlights in specific cities in our region, right? First of all, the host city for us here, Rio de Janeiro. This is this year, so the blue line is 2025. The purple line is 2024, and the dots are prices that hasn't been actualized yet. They're publicized now for the future, right? What we see is a huge start of the year for Rio de Janeiro. So a big increase in public pricing levels. You can see the two top hills. It's Carnival last year versus Carnival this year. look at the difference in terms of pricing points for these two major demand generator dates, right? So all the high season for Rio, really, really impressive. You can see the dots for the next few weeks way above last year. And also you can see for the rest of the year, the dots are kind of in line with last year, but there's still a window of pricing growth, right? And on average, prices in Rio, they grow 15% in a 120-day window. So that means that all those dots, they will get way above last year numbers. So a very, very impressive performance from Rio in terms of public prices. And the perspectives for the rest of the year, maybe not the same as this first 3 months. They are really, really impressive, but a very, very good perspective for the entire rest of the year. We can already see the dot line for New Year's Eve this year. It's way above the levels from last year already. So it's really good to see. When we look at Sao Paulo, it's not the same level as Rio. For you don't know, Sao Paulo has been increasing average public rates for years now. One of the cases here after pandemic in terms of steadiness of growth in terms of public pricing. But we can see the bar was really high, but we can see that even not having the same impressive level of demand as Rio is having, also because it's low season for the city, rates are very consistently higher than last year. So, and the perspectives are good until July. We can see a lot of dots above last year numbers, and we need to consider the booking curve. So there is still a huge space for Sao Paulo to grow. A little bit of attention between August, September, and October. Again, those dots will still grow when we get there, but when we look at, they're probably going to get it in line with last year. But especially the first half of the year has been really, really steady in terms of pricing growth. And we can see Carnival this year versus last year, also a big increase in average prices. Mexico is very impressive because there's no unique demand generator factor in the beginning of the year. So you can see the demand and the prices are very similar. It's almost a copy from last year, just in a way higher level. Another important case, Mexico City has grown a lot in terms of especially the last year, and this growth has been really impressive. You can see for the rest of the year, the majority of the dots are above already the levels, and those prices will still grow, so very, very impressive. And on the opposite, we have Buenos Aires, not a very strong start of the year, nor in demand, and reflection of that is nor in pricing. But we can see that as per the winter season, June, July, prices are already in the level above last year. So, and I think Patricia mentioned that yesterday, we're seeing a reverse in that trend, and things will get better as by end of April, May. But it wasn't the great start of the year. And then Santiago in line in terms of pricing with last year. We can see already in March a bigger increase. Demand was also higher this year for March than last year. The good news is when we look at July, June, and August, prices already, the dots are very close to last year. And we know that Santiago had a big increase in prices in like a 345 day window. So we forecast that those dots will be way above last year in terms of pricing for the winter season for Santiago, which is really important for the overall year results. So now looking at how prices are positioning, we're going to look a little bit about demand. So differently from pricing, and that's a very strong message, we believe, for the Latin market is demand increase 0.7 on average for this first half of the year, right? I'm going to explain how we calculate demand, but we just seen in the majority of the markets a very consistent growth in terms of pricing, but demand is not growing as much. What that means is we're still being able to apply pricing and increase our strategies in terms of public pricing, even in a scenario where demand is not growing at the same level, right? But there's still some very unique cases. How do we calculate demand? To serve our customers, we need to show demand. We need to give signals of demand way before demand happens, right? What's the purpose to give a demand information for tomorrow. That data is already given. Everyone knows how it's going to be. But for 4 months out, 5 months out, 6 months out, we need to kind of look at different data points. So we look at what we call pre-reservation data, which is flight search data, hotel search data, Airbnb search data, events in the city, pricing variations to be able to calculate that demand. So the information you will see here is based on that consolidation of data. First is Rio. So this is changes this year versus last year as per end of March until March next year. I mean, the ups and downs are based on when a particular event is happening. But the message here is, on average, you can see there is much more days where demand is slightly up on average or way up versus last year, right? So if I would put that on one bar, that would show a way higher increase in demand for Rio. And we just talked on Rio about the first quarter, January, February, and March, but the second quarter looks very promising also. If you look at demand April, May versus last year, it's a very aggressive growth in the majority of the days. There's a dip down in June, that's holiday, but you can see, like, if you look at the bar that is facing down versus a week later, the bar that's facing up, that is a holiday in Rio. So you can see how much demand you have for that day versus how less demand you're losing in a week before. So that's very impressive for Rio. In September, that's that big decrease is Rock in Rio. This year, there's no Rock in Rio addition, so that was expected already. So we can pull that off the graph, and then on average, you're going to see a lot of potential demand here for Rio. And again, if prices were in that level on the demand we've seen in the first half or first quarter of the year, we expect that prices continue to keep the same momentum if demand is still high. When we consolidate demand that we looked for in the last 4 years, and we put those in a heat map for the region, and developers, they love that view. It's basically where demand is more concentrated, right? For Rio, that's a little bit more given. Everyone knows that the south region here, Copacabana, and the other beaches are very strong in generating demand, but we've seen a slightly increase in demand in the Barra da Tijuca region versus a few years ago. Even, I'll say, even higher than the pre-pandemic levels for Barra da Tijuca. Sao Paulo, more or less the same scenario, much more positives than negatives. On average, for the majority of the days, demand is on level or slightly higher. We can see the trend also for Formula One. We spoke yesterday about the impact of the big events on markets and on demand. Again, we can see that the Formula One a week later, way higher in terms of demand increase than the impact of 1 week before in demand decrease, right? So that means even though that particular week doesn't have that even happening, the city is still being able to recover a little bit of that demand, plus inputting more demand a week later when the event happening. So again, Sao Paulo also followed that trend and is very sensitive when there's demand, prices really go up. So it's a very good perspective, especially now for months of April, May, early June. And again, there's a little bit of uncertainty in August, September, we'll have to have a look into, but in general for the year, a very promising year again. And again, when we concentrate the last 4 years of demand for the market of Sao Paulo, we have a clear vision where demand is really concentrated in the regions. Mexico City, again, had a very good start of the year, good demand in February and mid-March. And now there's very promising April and May. And throughout the year, we can look into November, December, and early next year. There's kind of a constrained events calendar, end of January, February, and March next year, which are very promising. Kind of a tension between July and August because demand is showing lower levels right now. But again, there's still time for recovery. In general, it's not the same scenario we've seen in Rio. Sao Paulo has a stronger increase in demand, but it's still steady, more ups and downs in Mexico City. And the start of the year has been really promising. Mexico City a little bit different because there is kind of a shorter, or could be kind of similar to Sao Paulo, shorter booking window. So these levels, especially for 60 days ahead, they will still grow. But when we compare same point in time, so this was comparing how demand is looking now versus how it was looking at the same date last year, this is the trend we have. And when we look at Mexico City also, the consolidation of demand and how it's geographically established in the city, we can see different regions. And there's kind of increase in Naucalpan de Juarez. We've seen a big increase in demand in that region. So Buenos Aires, we've mentioned, not as strong as demand in the beginning of the year. Occupancy dropped a bit. Public prices dropped, I think, more than expected. But we can see from April on a steady recovery. There is kind of still uncertainty in end of July, August in terms of demand. We think there is a very quick demand correction. So maybe if we pull that data in 60 days from now, 45 days, a lot of those down dates will probably be in line or slightly above. But there's not a huge ton of demand right now that we're looking into when we compare to demand last year. What that means is we need to take care of pricing ADR to keep pricing at a reasonable level, not to affect and have a double negative effect, lower occupancy and lower ADR. And then how the demand is spread when we look at the consolidated demand for the last 4 years in Buenos Aires. And then Santiago, again, didn't have also a great, strong start of the year. But when we look at especially the winter seasons, we know how important winter season is for this market. Demand is way, way higher. Last year, the ones of you that operate properties in Santiago or in Chile, you know how the last minute huge spike in demand happened all of a sudden. And right now, demand levels are looking even better than last year. So it's a very, very strong perspective. I think that is not yet reflected in prices. So prices are more or less slightly below or in line with last year when we look at demand as way higher than last year for winter season. So I think we're still in that start of that booking window for winter season in Chile. But I think it's time for, and we expect here, we forecast the prices to start to grow. Because it has to reflect that 25, 20, 15, depending on the week, increase in demand versus last year for Santiago. And then the second part of the year, the event calendar of the city as per September, October, November especially, there's less events happening in the city than we had last year. So that's kind of a yellow flag there. Take care of prices on the last quarter of the year because there is a less constrained calendar of events on the market for Santiago. And Santiago is very specific where the hotels are located, so nothing really that brings attention. The last part, again, I'm not going to get deeper in that conversation. We would have to have a panel for that, and I want to be cautious of time. But I just want to bring a few numbers that we have here for short-term rental on our region, because that kind of tells a story and brings us a little bit of information on how to watch that market. So in the past 4 years, that supply, short-term rental has grown 82%, their level of supply in our region, right? So almost doubled, right? So it's impressive. Rio, for example, is one of the markets in Latin America that has, I think it's a market in Latin America that has the biggest supply, almost 60,000 properties or rooms. And that growth it's really, we don't see that same growth in any supply in the hospitality market, nowhere, right? Only in the past half, so in H2 2024 versus H2 2023, that supply has grown 10%. So it hasn't slowed down. It has been a little bit steadiness. We saw after pandemic, like 30% growth, 25, 20% growth on a half. It has dropped H1 last year to 18 and now to 10, but it's still a 2-digit growth in a half, right? When we look at the average occupancy for the LATAM region is slightly below than other regions like North America and Europe, but it's growing, right? And it's at 42%. And again, that's a occupancy percentage on a supply that has 82% growth, right? So when we look at an absolute number of travelers staying in those properties, it's way, way higher, right? Because the percentage is growing on a supply that's growing at 82% in a four-year window. When we look at changes in ADR, it's very, very consistent, also the growth. So when we look at H1 last year versus H1 2023, 11%, and H2 almost 16%. We saw the growth in pricing, public pricing. So this is ADR, not public pricing for short-term rental, but it's a very, very steady growth, right? It's following hotel prices, and hotel ADRs are pulling up the space for short-term rentals to also grow there because they follow a lot the transit hotels, what hotels apply. So that opened them space to charge more and increase their rates. So we've seen a substantially growth and a sustainable growth in ADR for short-term rental. And that's the average ADR in USDs, right? So one thing is for LATAM, the short-term rentals, different from other regions, we would say, they're very economic, right? In majority. There's different kinds. We cannot put all of them in the same bucket, but they're very economic, right? So we can see that reflected in ADR. ADR has slightly grown from $102 to $118. But what that affects is the economic low mid-scale business, right? Because they compete directly. They compete on location. They compete on the profile of the segment of the customers, and even in more, especially in price, right? They're very competitive in terms of pricing, and that affects, we've seen, I think Patricia shared yesterday, the ADR stable in terms of economic, mid-scale, I think especially economic. And one of the reasons I believe is affected by the short-term rental properties, because they are very competitive in terms of pricing versus the economic hotels that we look into. So short-term rental, just to close that, short-term rental has had an impact. We've seen that impact in terms of growth supply. You guys know exactly much better than I do. How do we supply in a market affects general occupancy levels? But I think we are seeing that effect in a very deep way, the economic low mid-scales. But in general, the good news is we're looking at steady prices growth in the majority of markets. LATAM is growing public prices more than the rest of the world. In a majority of the markets that we've seen in this presentation, demand is in a higher level than it was last year. And even other markets, we overlook more than 45 markets for that study in our region. In a majority of the markets, except a few examples, demand is very strong, and the reaction from hotels in terms of pricing positions to demand is really strong. So that's a very positive perspective for the rest of this year and for the years to come. Thanks again, Florencia, Arturo. It's a pleasure.